Hey guys, how you doing? Kunal here at Bulls on Wall Street. Guys, welcome to my introductory course. Today, I'm gonna walk you through my passion, which is the stock market. We're gonna be going over in detail today everything that you need to know about the stock market and how to get started trading, and then what tools and tactics to use so that you can hit the ground running. For a lot of you guys, you're probably just brand new and you don't even really know what the stock market is. The way to think about the stock market is it's a giant auction full of buyers and sellers. And what they're doing is trading a commodity, which is a stock. And for a trade to be taken, there must be a buyer and seller, and they have to meet somewhere and have an exchange. And that's what a trade is. So anytime you think of a stock, whether it's Google or Tesla or Apple, how a trade is made is there's a buyer and there's a seller. Now, the beauty of the stock market is there are thousands and thousands of buyers and sellers at any given price point. So a trade can always be taken. So the question is, where do we make these trades? Like, how do I get my hands on something like a Tesla or a Google or an Apple? Where you make your trades is simple enough, at a broker. There are tons of brokers in the United States with all different names and tools and features. But frankly, for what we're trying to do, the basic brokers and the biggest ones around are usually the best ones to start at. You've probably heard of companies like TD Ameritrade, E-Trade, Schwab. All of these are fantastic brokers that will be able to do everything that you need to do for your trading and investing purposes. So a question I get asked all the time is, okay, I want to buy a stock. Well, now we know where to buy a stock. You have to do it at one of these brokers. I have accounts at E-Trade and Ameritrade, and I do a majority of my trading through them. So when you can make a trade is a great question. The stock market is open 9:30 in the morning to 4 p.m. where it closes. Now, they do have kind of pre-market and after-hours trading, but that is probably a minimal part of your trading strategy. 99.9% of the trades that get taken place in the market happen between 9:30 and 4. So you have very set hours. Okay, so 9:30 the bell rings. So now what do? What do you trade? Well, in the stock market, there are different instruments that you can use to actually go out and make purchases for investing. We, of course, have stocks. Those are your companies, the companies that you've heard of and the companies you haven't. The beauty of the stock market is there are 8,000 stocks that you can trade. So many of them are going to be moving around every single day that there's always opportunities. Beyond stocks, there's other instruments that you can purchase. Things like ETFs. An ETF is an exchange-traded fund. The easiest way to think about that is an ETF is a fund that mimics a particular index. So for example, they have an ETF called the SPY. The SPY is an ETF that tracks the general market. That's your S&P 500. DIA, that is an ETF that tracks the Dow Jones. So when you hear somebody and you're talking to them like, hey, what's the market doing? And they're like, oh, the market's up 500 points. What they're talking about is the Dow Jones. You can actually trade the general market index if you want just some exposure to the overall market. Now, the cool thing with ETFs that's happened in the last 5 years is they have made ETFs to track every type of industry imaginable. Electric vehicles, the ETF name is DRIV. Gold, the ETF name is GLD. Silver, the ETF name is SIL. Anything you can think of, from oil to commodities to electric cars to wind power to China, they have ETFs to actually mimic those countries or those indexes and commodities. A lot of people that are more into passive investing, meaning they want exposure to the overall market, will purchase a basket of ETFs to give them that exposure so that they don't have to sit there and sift through thousands and thousands of stocks. It's a great way to go if you're looking to do some part-time trading or some passive investing on your own. Guys, let's talk about different types of trading. I'm sure you guys have heard like things that on CNBC or through the wire or what your friends are talking about. You know, when they're talking about stocks like GME or AMC. A lot of that type of trading is short-term trading, or what we would call swing trading. Swing trading is a type of trading where you're looking for certain patterns and identifying inflection points so that you can capture gains between 3 and 14 days. Why is that important and effective strategy? So when you look at a stock's chart, what you'll notice is that a majority of stocks make their moves in a month over just a period of a few days. So what a swing trader does is use technical analysis to find specific spots where they can enter with low risk and capture those 3 to 5 day explosive moves, and then they get out. It's totally different than investing where you're buying and holding something for a year or 2 years or 3 years. With swing trading, what you're trying to do is take and encapsulate that very, very short burst of momentum, take your profit, and run. So if you look at a chart like GME is something that everybody's been talking about nonstop. One of the things you'll notice on this chart with GME is it went from $15 all the way to $500. But look at how quickly it did it. It did it in a matter of a week or two, a very, very short-term move. But now if you're looking at GME, what has it done? It's come all the way back into the 100s. A swing trader identifies when a stock is about to explode, they pounce on it, and then they quickly get out. In my trading boot camp, I spent 6 days talking about swing trading tactics. Those are tactics that you can use from your smartphone or your iPad, and you can do it while you're working. The key is, for this type of strategy, to have an understanding of chart patterns, capture those quick gains, and then you get out. The worst thing a swing trader can do is hold on too long. What you'll find in any given stock over the course of a year is 5 to 10 opportunities where they capture big bursts. Then a majority of the time, stocks tend to sit around. So if you're thinking about a stock like, say, Apple, when it makes its moves, it'll do it for 5 or 10 days, and then it just tends to sit around. So what we want to be doing is thinking about efficiency. How can I capture the most money in the shortest amount of time and then move my capital to something else that's about to go? Where an investor will sit there and hold through those ebb and flows, we're sitting there riding the wave, getting out, and then finding our next opportunity. Now let's talk a little bit about day trading, and that's my specialty. I'm day trading in and out every single day, dozens of times a day. Day trading is when you're buying something during market hours, and then you're selling it that day. Sometimes my day trades can last for hours, and frankly, a lot of times, they can last for minutes. Take a look at this TKAT. This is an NFT stock that I've been trading every single day. What you'll notice about stocks like this, and this is my specialty in finding them, is that they can make explosive investment type returns, but they can do it in a couple hours. My whole day trading strategy is finding the stocks that are going to make 50%, 60%, even 100% moves in a day, and then capturing those chunks while minimizing risk, but I'm only holding them for a handful of minutes to a handful of hours. So you'll see like a stock like this TCAT, I ended up buying this at $29. By the end of the day, it ran to $45. And I'm trading the ebbs and flows using simple chart patterns that really anybody can learn while managing my risk so that if the trade goes against me, I'm out in an instant. Now, a lot of you guys are wondering, like, okay, this market is hot. There are stocks like GME or this TCAT that are moving hundreds of percent in a handful of days. But what happens when nothing is moving like that? Well, this is the awesome part of the market that a lot of retail traders, and frankly, I didn't even know about when I started trading, is that you can short stocks. Shorting stocks means that you're actually betting on a name to go down. I would say in any given year, 25 to 35% of my trades are on the short side. At some point, a stock gets so extended and so overvalued that you have no choice but to take the other side. You can do a short trade, which is just the opposite of buying a stock, and you will profit when that stock goes down. So a stock like GME or AMC or this TCAT, as you can see from these charts, at some point they go on such a big run that they're going to collapse. And our job as short-term traders is to find those points where they're going to roll over, and then we profit from it both ways, as they go up and just as much as they go down. Great traders, they know how to trade both sides. They know how to buy stocks, but also they know exactly when to come in and short those stocks. Frankly, it's not as important right now because we've been in a bull market for so long. But most bull markets run for 10 to 12 years. And we're in year 12 of a bull market. I personally believe that short selling stocks is going to be an important feature of your trading and something that you must learn. One of my best trading years ever was in the 2008 crash. That year, most stocks fell 70, 80%. It's crazy. But when stocks fall, they can fall much faster than they go up. And so we need to know how to short sell for when that time comes, as there's market crashes all the time. Check out the tech index of the QQQ during the coronavirus crash. The market came down 50% in just a handful of weeks. Stocks like this RCL, CCL, Carnival Cruise Line, they dropped 80% from their peaks, and they did it in a matter of weeks. What took years to build up fell in 2 weeks. Short selling can be a highly profitable trading strategy, and frankly, it's just kind of fun because when stocks fall, they fall a lot faster than they go up. And you can take those years of gains and ride it back down in a matter of days to weeks. I personally believe this is something that we all have to work on, for that next bear market is always around the corner. We can never be too complacent.